Hello and a very warm welcome to this Insider interview. My name's Dave Baxter and joining me today is Job Curtis, Fund Manager on the City of London Investment Trust. Job, thank you for coming in today.
It's a pleasure.
So, Job, for people who don't know City of London, it's a UK income fund. It seeks out some of the kind of juicy dividends in the market. But if I look at your fund literature, you do hold some of those stalwarts, your Shells, HSBCs and so on. In that context, what actually sets you apart from other UK income funds?
Well, I think we're particularly known for our dividend growth record. We've grown our dividend every year for 59 years in a row, and we've benefited from the investment trust structure, which has enabled us to do that, as well as a core of consistent companies. But we have overall a total return objective, so income and capital growth, and we've beaten the index over the long term with a conservative investment strategy, and I think we're well known for that as well.
It's been an interesting 2025 for UK markets. What notable portfolio changes have you made?
So in 2025, we've particularly benefited from our position in the bank sector, which about 2 years ago, having been quite low in banks ever since before the financial crisis, we moved to a sort of overweight position in banks, and that was taking a view about something called the structural hedge, which are the balances that the banks hedge out on a kind of 5 to 7 year view. The UK banks do quite conservatively, and these hedges were taken out when interest rates were ultra low, now getting rolled over at much more attractive interest rates. And this is a kind of tailwind to profits, which was, in our view, was being underestimated by the market. And we have seen very strong performance by the bank sector against that context. In terms of the main change, we've seen sort of takeover activity in our portfolio. In particular, for example, Direct Line, the insurer, was taken over, and by Aviva, which we already held, and we bought Admiral in kind of replacement for that. So kind of very good motor insurer. Dowlais, which is a kind of motor component stock, was also taken over. So we've seen takeovers. We quite like real estate investment trusts at the moment, and one we've bought is Big Yellow, the storage company, which is actually very soon after we bought it, received a takeover approach from Blackstone. So, but I would say the kind of main theme really has been our kind of position in financials and the banks, which has been helpful to both capital performance and dividend growth for the portfolio.
You have a very long history of dividend increases, and of course there will be pressure to keep that up. What's going to drive those increases? And have you considered an enhanced dividend policy where you use, for example, capital growth or revenue reserves in order to just keep those payouts rising?
No, we've been very clear that we are not going to do an enhanced dividend policy. I mean, in our chairman's statement recently, we made absolutely clear the board is firmly against that. We think when everything's going up, people don't notice a bit of the dividends paid out of capital, but we think in flat or declining markets, shareholders will be very upset to see that part of their dividend is being paid out of their own capital. So it's like robbing Peter to pay Paul. And we just think it's a flawed strategy which hasn't been tested in bear markets, and we will have another bear market at some point. So we definitely intend to continue to pay our dividend out of the dividends we receive. And, we certainly are very comfortable with that strategy. We're seeing decent dividend growth across a lot of our portfolio, and confident we can build on our record. But as I said earlier, we do use the investor trust structure in difficult years for dividends, such as during COVID, when FTSE 100 dividends went down by 36%, and we carried on growing our dividend. And we did it because in the good years, we can put money into the revenue reserve up to 15% of the earnings, and that builds the revenue reserve up, and then you use that in difficult years for dividends. So that is a kind of advantage investors just have over open-ended funds.
You do hold some lower yielding shares, for example, BAE Systems, alongside the bigger payers. What sort of names are you holding and why?
Yes, I mean, BAE was a kind of medium yield when I built the holding up. And then I think with the Ukraine war, that we're in a new era, the kind of post-Cold War peace dividend is kind of over, and our countries are rearming, and BAE has got heaps of good technology and is in an incredibly strong position. I mean, it may be the UK's biggest defence contractor, also the 6th biggest in America, but also got huge important positions in Europe, in Asia Pacific countries like Japan and Australia and in the Middle East. So it's a very strong company and has re-rated. We have taken some profits in it, but another very good example of a low yield we hold is Relics, which is in our top 5 holdings. This is a kind of provider of business information analytics, essential kind of information for kind of insurance companies as they measure risk of kind of underwriting, or kind of legal firms. They're the biggest second publisher of legal material globally, including America. And they're already using artificial intelligence in the services they provide their clients. And they're also the biggest scientific publisher in the world. So it's kind of provides essential information for kind of professionals and businesses, and also got an exhibitions business. So it's a really high quality company with a kind of strong moat around its business, and has performed very well over the years. And we got a lot of confidence in it, and have maintained it as a big holding. So, but we've got within our, if you look at our portfolio, we've got sort of some stocks in there more for their yield, kind of the yielders, where, you might get pleasantly surprised by a re-rating, possibly. But, we're confident that the dividend will be paid and be grown. But there are other companies in the portfolio like BAE and Relics, which are more in for the capital growth. And they still pay a dividend, which is growing, but it's obviously on a much lower level. But it's a kind of balancing act, and having enough of the high yielders and also the low yielders as well.
Like some of your peers, you do fish in overseas markets as well. What kind of overseas shares have earned a place in the portfolio?
Yeah, I mean, it's important to sort of say that the UK stock market, although companies listed in London, they are actually very global. And if you drill down into our portfolio, which is over 90% UK listed shares, we are some 60% of the underlying sales is overseas. And so, you've got major companies like Shell or Unilever, which are completely global companies, happen to be listed in London. But in addition, we can access overseas listed shares. We're allowed to go up to 20% of the portfolio. And a few years ago, it was up to about 17%, but I've actually reduced it down to about 7% because there's so much more value in the UK market at the moment. The UK market is, in my view, offering exceptionally good value relative to overseas markets. So it's at quite a low ebb. But I mean, give a couple of examples. I mean, Total Energies is the French-based oil company, and in 2020, both Shell and BP cut their dividends, sadly. And whilst Total didn't, it continued to grow its dividends. So we switched some of our Shell at that point into Total, and we've still got a big position in Shell, but we've kind of maintained Total as this kind of a third string kind of major oil company. And another example is Munich Re, which is a big German-based global reinsurance company, which has done very well on the back of kind of also strong market for reinsurance. And that's, we have got some sort of interesting Lloyd's insurance plays in the portfolio, such as Beazley and Hiscox, but they're kind of more niche and smaller, whilst Munich Re is also added to our kind of what is quite a big position in the reinsurance sector in the portfolio.
And finally, our normal question: do you have skin in the game?
Yes, I'm very happy and pleased to have got some 313,000 shares, which are worth about 1.6 million at today's share price.
Job, thank you for your time.
It's a pleasure.
So that's it from us. Many thanks for watching. Do let us know what you think in the comments. And if you enjoyed this series, do hit the like button and hit the subscribe button. Take care.